You know that moment when two doctors look at the exact same x-ray and give you completely opposite diagnoses? One says you're fine, go home. The other says we need more tests immediately. That's not a hypothetical. That's the US economy right now. Except instead of two doctors, it's hundreds of economists. And instead of an x-ray, it's the exact same government data. Some of them say the patient is thriving. Others say prepare for the worst. Here's the wild part. They're not lying to you. They're looking at the same numbers and reaching different conclusions because this economy is doing something most economies don't do, succeeding and struggling at the exact same time. My name's Bob. I spend way too much time reading things the Federal Reserve writes, so you don't have to. If you've ever wanted to understand why economic headlines contradict each other constantly, instead of just picking whichever one confirms what you already believed, hit subscribe. This is a skill you'll use every single year, not just this one.
Let's start with the number everyone loves to argue about: GDP growth. Late last year, the economy barely grew at all, 0.5%, practically a coin flip between growth and shrinkage. Then it doubled to around 2% in the first quarter of this year, with forecasters landing around 2.2% for the full year. Not spectacular, not a disaster. Think of a hiker who stumbled on a loose rock, caught their balance, and kept walking, a little slower. Nobody's calling search and rescue, but nobody's setting a speed record either. So why does this year feel like everyone's celebrating and panicking at the same time? Because there isn't one economy running right now. There are two, layered on top of each other, and most people only ever see the one that isn't theirs.
Picture the first economy like a rocket launch. Business investment jumped over 10% in a single quarter, almost entirely because of one thing: artificial intelligence. A handful of companies, Amazon, Alphabet, Microsoft, Meta, Tesla, projected around $750 billion in spending this year, most of it aimed at chips, servers, and data centers. Amazon alone committed up to $200 billion in capital spending, the largest single-year guidance from any American company in over a decade. Last year, AI investment alone accounted for more than a third of all GDP growth. That's not a sector contributing to the economy. That's 5 companies functioning as one of its main engines. Remove those 5 names from the spreadsheet and the whole picture looks weaker. The stock market noticed. The Dow, the S&P, the NASDAQ all posted some of their best months in years this spring. Recession odds on prediction markets dropped to record lows.
If your only window into the economy is a stock ticker, 2026 looks like a rocket, and everyone's invited to ride it. Now picture the second economy, like a car running low on fuel. Not stalled, not sputtering, just quietly less capable than it looks from the outside. Consumer spending, historically the biggest engine of US growth, is showing real fatigue. Real income growth has been slipping. Retail sales, adjusted for inflation, have weakened. And the labor market tells its own quiet story. Job gains this year have averaged around 92,000 a month, which is a big improvement over last year's roughly 10,000 a month average, but still far below what a genuinely strong labor market produces. Companies aren't firing people in droves. They're just not hiring much, letting attrition quietly do the work instead. Nobody panics, nobody celebrates. The tank just keeps getting a little lower, mile after mile, and you don't notice until the warning light comes on.
So you've got a rocket and a car running on fumes, occupying the same country at the same time. Whichever one you personally experience depends almost entirely on whether your paycheck is tied to AI infrastructure spending or tied to rent and groceries like a normal human being. This is why two people can watch the exact same news broadcast and walk away with opposite feelings about the economy. They're not disagreeing about the facts. They're living in different halves of the same country. Then a wild card nobody planned for showed up: war. Conflict involving Iran sent energy prices spiking, and that single shock rippled through everything downstream of it. The Fed's preferred inflation gauge jumped from under 3% to nearly 4% in a couple of months. Consumer prices jumped even faster. Energy inflation alone spiked more than 17 percentage points. Imagine filling a bathtub at a steady rate for months. Then someone opens the hot tap all the way with no warning. That's what happened to inflation expectations this spring.
Here's why that shock matters more than it seems. Normally, when growth slows, the Fed cuts rates to stimulate the economy. That's the standard move, the one everyone expected this year. But if inflation is rising at the same time, cutting rates is like pouring gasoline near a fire that's already burning. So some Fed officials floated the opposite idea, raising rates instead of cutting them. When a new Fed chair took over this year, markets that had priced in 1 or 2 cuts suddenly started pricing in a hike instead. Imagine planning your mortgage refinance around rates are coming down, then watching that entire premise flip in a single Fed meeting. That's not a hypothetical. That happened to millions of people's financial plans this year. This is the definition of a bind. Growth too fragile to justify tightening. Inflation too sticky to justify loosening. Economists have a name for that ugly combination: stagflation. Slow growth and rising prices at once. It's rare, it's miserable, and some forecasters now put the odds of a downturn this year at around 50%, nearly double what it was before the war started. That's not a fringe take. That's a coin flip from people whose entire job is reading this data for a living.
But here's where the two-doctor problem shows up in full force. Other forecasters, staring at the exact same numbers, reached the opposite conclusion. The Treasury's own outlook this spring called recession risk relatively low, pointing to strong business investment and wages still outpacing inflation. A Wall Street Journal survey of economists in April put average recession odds at 33%. One widely cited bond market recession model, the kind that's correctly called nearly every US recession since the 1950s, put the odds at under 18%. Same data, same country, same month in some cases. Anywhere from under 20% to roughly 50%. That's the entire range of a coin flip, from people with PhDs in Bloomberg terminals looking at identical spreadsheets.
Before we go further, it's worth asking if we've been here before. The closest comparison economists reach for is the 1970s. Oil shocks, rising prices, weak growth, a decade-long headache called stagflation. But the comparison breaks down fast. In the 1970s, there was no equivalent of companies pouring hundreds of billions into a technology that could reshape entire industries. There was no AI cushion absorbing part of the shock. What we have now is a hybrid. Some warning signs from the 1970s, sitting right next to something the 1970s never had. A real productivity-driven investment boom, happening in real time. That combination doesn't have a clean historical parallel, which is exactly why the forecasters keep disagreeing. So which diagnosis do you believe? Here's the reframe that actually matters. Stop asking which economist is right, and start asking which forces are currently fighting each other. That's a question you can track yourself, in real time. No finance degree required.
Think of the economy like a tug of war with 4 teams pulling on the same rope. The rope's position, not any single headline, tells you who's winning. Team 1 is AI investment, pulling hard toward growth. If this spending keeps flowing and eventually turns into real productivity, today's sky-high valuations start looking justified instead of bubbly. Some estimates put the potential value creation from generative AI as high as $8 trillion for US firms. This is the team pulling hardest right now, and it's not close. Team 2 is the AI bubble risk, pulling from the opposite side using the exact same rope. This isn't hundreds of companies spreading the bet around. It's a handful of the largest corporations on Earth making enormous concentrated wagers on the same technology at the same time. If even 1 or 2 lose their nerve, the ripple through GDP and markets could be sharp, like a tug-of-war team that suddenly lets go of the rope. Team 3 is oil and geopolitics, the wildest card on the field, because its strength has nothing to do with spreadsheets. As long as conflict continues, energy prices stay elevated, and the Fed stays boxed in. Some analysts argue there's a war premium baked into oil prices right now, with forecasts putting oil in the mid-80s this year, possibly drifting lower next year if the conflict resolves. Pull that premium out, and a big chunk of the inflation problem disappears almost overnight.
Team 4 is the consumer, quietly the most important team because it's the biggest one.
Real wages have technically outpaced inflation on average, but the gains are uneven. Higher income households are doing most of the spending, buoyed by rising stock portfolios, while everyone else is quietly pulling back. If that middle and lower tier keeps tightening, the resilient consumer story cracks, and consumer spending is still the single largest slice of GDP. Some economists call this a K-shaped economy. One line goes up, one line goes down, and both get averaged into a single, misleadingly tidy number on the evening news. Here's what nobody explains clearly. Recessions aren't predicted the way weather is predicted. They happen when enough of these teams pull in the same direction at once. Right now, no single team is strong enough to win alone. But watch what happens if oil stays high while AI spending stalls at the same time. That's not two problems, that's one problem squared.
Picture the different outcomes. If AI investment stays strong and the war resolves quickly, oil drops, inflation cools, and the Fed gets room to cut again. That's close to the best case. If the war drags on while AI spending shows its first real cracks, the Fed gets stuck between inflation it can't ignore and growth it can't support. That's close to the worst case. Most likely, we land somewhere messy in between, which doesn't make for a clean headline, but it's probably the most honest one.
Now, here's the part most economic content skips entirely. Uncertainty like this doesn't just create risk, it creates perspective, if you know how to use it. When rates are uncertain, people who lock in decisions instead of waiting endlessly for a perfect number often come out ahead, simply because they stopped paying the cost of indecision. When markets panic about a handful of companies, it's usually a reminder that headlines move faster than fundamentals do, and the two aren't always the same thing. When consumer spending gets shaky, it's a good moment to notice which parts of your own budget are necessities and which are habits dressed up as necessities. I'm not a financial advisor, and none of this is a recommendation to buy or sell anything specific. It's a mindset shift. Uncertainty isn't just something to survive, it's information, if you're paying attention instead of panicking.
This is one of the more counterintuitive lessons in personal finance. The years that feel scariest are often the years where staying consistent matters most. Nobody rings a bell at the bottom of a downturn. Nobody sends a calendar invite for the exact moment a war resolves. By the time uncertainty clears up enough to feel comfortable, the moment that mattered has usually already passed. The discomfort you're feeling right now isn't a sign to freeze. It's usually just what a genuinely uncertain year feels like from the inside. So what do you actually do with all of this? First, stop timing your decisions around recession headlines. Markets and sentiment often shift before a downturn is officially confirmed, and by the time it's confirmed on the evening news, a meaningful part of both the damage and the recovery has usually already happened. Second, build your own walking away money. 3 to 6 months of expenses is what turns a shock into an inconvenience instead of a crisis. With hiring already running well below a healthy pace, that cushion is the difference between calmly searching for your next opportunity and desperately taking the first offer out of fear. Third, watch what's actually hitting your bills, not just the headline growth number. If you feel squeezed while GDP technically grows, that's not you being bad with money. That's the two-economy problem landing directly on your household. Fourth, don't confuse a booming stock market with a booming economy. A handful of massive companies can drive the index higher while most workers feel stretched at the exact same time. Both are true, and knowing that gap is the difference between reading a headline and understanding your actual situation. Fifth, track 2 numbers that matter more than any pundit's take: the Fed's next rate decision and how oil behaves if the war starts resolving. Sixth, resist the urge to make big, irreversible decisions off 1 month of data. One strong jobs report doesn't fix the labor market. One bad inflation print doesn't confirm stagflation. If professional economists keep swinging their views week to week, you're allowed to hold your own plans a little more loosely too. Here's the distinction that actually separates people who come out of uncertain years ahead. It's rarely about who guessed right. It's about who kept contributing to their investments on a steady schedule, who kept their spending intentional instead of panicking into either extreme, and who treated their emergency fund as untouchable insurance instead of a backup vacation fund. The people who navigate uncertain years well aren't the best predictors. They're the ones with the most boring, consistent habits. Here's the thing that ties this together. Every milestone we've talked about, that first $10,000, that $20,000 threshold, matters more, not less, in a year like this one. You can't control the Fed's next move. You can't control oil prices in an active war zone. You can't control whether AI spending becomes durable productivity or a spectacular bubble. But you can control whether you have savings. You can control whether you're carrying debt that assumed rates would only move in one direction. And you can control whether you're deciding from fear or from a plan. The real skill isn't predicting whether 2026 lands on recession or recovery. Nobody has that answer locked down right now. Not the Treasury, not Wall Street, not the bond market's famous track record. The real skill is building a financial life sturdy enough that the answer doesn't decide your future. You do. Whichever way this rope gets pulled by December, your future self is the one still holding the other end. They'll thank you for showing up prepared, not just surprised. If this helped you make sense of a confusing economy, subscribe so you don't miss the next one.